Hello, I am Piyush Dave, a fintech professional, and today I'm going to talk about one more algo trading technique, which is based on volume pressure index. Now, this will not tell us whether to trade on a positive side or a negative side, but this is going to tell us what quantity to trade. Like if the VPI is of certain dominance, that means there is a strength in VPI is happening, then we are going to trade with the highest number of quantity. And if there is no change in dominance, we are not going to trade. Now let me show you this first in GUI, then you can able to understand the mathematics also. So the GUI is very simple one. There is a price which is changing, there is a buyer volume, there is a seller volume, and it is suggesting not to trade because the buyer volume and the seller volume is very much close to each other. So it's suggesting not to trade on this side. Don't trade for any number of quantity because the buyer volume and the seller volume is same. Now suddenly, if the good news come, so that means buyer volume is going to increase, the price is increasing, the buyer volume is increasing. That's why it is asking you to trade for 25 quantities. And after certain time, if the impact of the good news went up, went, then it is going to say, okay, trade for zero quantity. So it basically checking continuous basis buyer volume and the seller volume. See, again, I have created the buyer volume artificially and it is asking you to basically trade for 25 quantity. And it's saying it's a weak dominance of the volume pressure index. Now, suppose if the best news has come, so there is a clear dominance you can say. And you can even create a hard dominance also. It increase the quantity for the trade. See, two way you can play. If you want to play a volatility, which considered to be slightly risky, but it give a very good result. Like profitability is very high in high volatility. Some people play in a different game. Like if there's a volatility is high, then they stay away from the market. They want to trade in a stable market. So the people who want to work in a stable market, this is an indicator where they don't want to trade. And some people actually look for a volatility. If the volatility increases, then they only trade. So this is the best indicator. Now, if the bad news has come, you can see the VPI has become negative. Okay, I just create a worse news. The VPI become dominant because the seller volume is increased. You can see the seller volume has increased. And if this news once settled down, the dominance went down and it shows, then don't trade for more quantity. Okay, if there's a bad and good news come back to back, so bad news has come, then the good news has come. Okay, it wait for the clear dominance. Okay, the best news has come. See the beauty of the trade which is happening. Now I'm going to show you how it is happening in actual real calculation. So the actual real calculation works this way. We are going to collect the 5 price from the market and the buyer volume minus seller volume, buyer volume plus seller volume. And this is basically the rolling volume which we are accumulating from the market. Let me show you this. First, this is a buyer volume and this is a seller volume which is happening in each 5 ticks. We are going to add all the buy volume, we are going to add all the sell volume, and in this formula we are going to put buy volume minus sell volume, buy volume plus sell volume, summation of all this, and we get the value as VPI is 0.17, and the threshold for the VPI we capped at 0.020. So VPI which is coming 0.17 is not enough, so it's not going to trade at, it's not going to tell you any quantity to trade. Basically don't give you the direction, it give you the number of quantity to trade. If there is a more VPI on either positive or negative, it is going to say number of quantity. Now suppose the next price come in the market, the sixth price which has been added to the previous one, and we get the new VPI. Now the new VPI suggests, okay, it's a weak dominance, but you can trade for a small quantity for sure because it's greater than 0.20. Now the next two price come again, the rolling buy and sell will be increase or decrease, and based on that it is also increase. So again it's a weak dominance only because we decided the range for the weak dominance is 0.20 or 0.39. So it is going to trade for 25 quantity. Similarly, for the clear dominance, we need the 0.4 to 0.59. For the strong dominance, we need 0.6 to 0.8. And for the extreme control, we go for 0.8. Like a continuous base of the volume should be generated for entering into all quantity, like 100 of 100. Okay, so if 0.72 on the next, we have a clear dominance, we can go for the 0.7 aggressive. Similarly, for the extreme control, like buying volume is continuously increasing, so we can go for 100 quantity to trade. Uh, if VPI become again small, then we will exit, or if the VPI is in decreasing uh, one by one, then we will reduce the size of the trade. And even with the time decay also, if the VPI reduce, then we are going to reduce the number of quantity. So VPI does not predict the price. It measures the dominance of either buyer or seller, and based on the dominance, we decide the number of quantity to trade. So it's not about the direction, it's about the quantity to trade in the market for the buyer and seller, for the buyer and seller dominance. This is a very good example um, to understand the VPI. It's kind of a it's kind of what we can say index for us to understand the trading pattern. Let me explain this one more time so it will be more clear. A summary: five readings we are taking. The range of VPI is -1 to 1. Volume pressure index. Volume pressure index whether check whether there is a dominance of the buyer side or a seller side, and based on that we are going to trade. If the buyer volume and seller volume is calculated on a rolling base, we can calculate the VPI. VPI we are going to kept a threshold of 0.20. If it come above that, we are going to trade with a small quantity, and the VPI increase on a positive or negative side, we are going to increase the number of quantity based on the change in VPI. So first part is the buyer volume and the seller volume. We calculate in a rolling way. Then we are going to keep this price inside this, and we are going to check the VPI dominance. And if the VPI dominance is not the value which we want, we are not going to trade. And if the VPI dominance is above that value, we are going to trade. So number of quantity is being decided with the logic of the VPI calculation. The key insights is continuous ruling buyer and seller volume will be added, and based on that the VPI is decided, and VPI decides the number of quantity to trade. So here we kept the table like this: 0.20 or 0. Up to 0.39 we consider it's a weak dominance, and we are going to trade only the fourth quantity of the total quantity we want to trade. Similarly, the clear dominance, the strong dominance, the extreme clear dominance. Uh, and the interesting fact of this is to reduce the trade or to come out of the trade is depend on the VPI collapse. If the VPI is less than 20, we are going to exit. If the VPI is reducing, then we are going to decrease the size of the trade. And if there is a time decay, like VPI is a flat, then again also we are going to stop the trading. So VPI does not predict the price. It basically shows dominance of the buyer or seller, and based on that we decide the number of quantity to trade. So let me show you this in actual market scenario. So this news is being generated in a way that either it's the best news, neutral news, bad news or the worst news. Based on that, we are going to decide the the change in the, okay, and majority time we created a neutral news only. Okay, so this is a news which is generated in every 10 to 20 second, and these news are random in nature. We have no control over it. So we just make sure to have this window on one side. Okay. Now based on this news, we basically we basically change the exchange price. Based on this news, we are going to change the exchange price. So let me adjust this window. Okay, this will tell us the different news which is happening. Okay, currently there's a bad news happening for the stock. Now the exchange is designed in a way that it basically behave on that kind of a bad or good news. And based on that, the volume is also going to change, increase or decrease. So now I'm running this. Now, if there's a bad news, the buyer and seller volume is decided that way. Okay, if there's a bad news, the seller volume is more. Okay, now let me adjust both the windows so that we can see it parallel. Okay, this is a bad news which is coming in the market. Okay, this is a bad news. And once the news is applied, you can see the change in the price. Okay, I think this both window we can see together. Bad news has come and the market is behaving. The seller volume is more. Now I just want my algo to fire on this logic. Okay. If bad news is coming, you can see there's a one more bad news has come. So the seller volume you can see increase, the buyer volume is decrease. Okay, now we are going to fire our algo on this. So this is being decided with the max quantity, and we kept a delay of 3 seconds so that we can see what is happening in the market. And now the maximum quantities depend on the VPI which we are going to calculate from the ruling price of the market. Okay, so the first VPI is a flat VPI. You can see there's no, okay, there's a small scale which has come. Okay, let me adjust all the window. Okay, this is the window number 1, window number 2, and this is window number 3. Okay, you can see there is a no news has been there. Okay, there's a micro drift. Okay, now the bad news has come. Bad news has come. Okay, there's a dominance is going to increase for sure. Okay, I think for a worst news, it is going to increase more number of quantity. If there's a micro drift, the VPI is very low, so it's saying I'm going to trade very small. See, the VPI is decrease. If there's a small micro drift, it is not going to trade. Okay, there's a bad news has come. So the VPI is going to increase for sure. Bad news has come. Okay, again it is micro drift, so it's not trading. Okay, the bad news has come. Okay, you can see uh, it says okay, trade for 25 quantity. I think for a worst news, it is going to say 50 quantity, but it has to be in a continuous nature. Okay, if the neutral news come, if the neutral news is there in the market, it says don't trade because the VPI has no dominance. It says no quantity. Okay, the best news has come. Okay, the VPI is going to increase for sure. The best news has come. Okay, you can see buyer and seller. Okay, weak dominance again. So the market, okay, I can do one simple thing. I can increase the number of second. The delay time which I've kept over here is 3 seconds. Okay, instead of that, we can decrease the delay. But when I decrease the delay, it is very difficult to observe on a screen. Very difficult to observe on a screen because it happens so fast. Okay, still you can see because the market is behaving fast and our algo was slow. So that's why. Okay, now there is no delay, you can see. So it's behaving the same, like it's responding very fast to the market. Okay, if something happens, you can see now the worst news has come. So dominance, it has to go above 0.4. Then only this 25 quantity become 50 quantity. And if there's a neutral news come, it become like a balanced trade and it come out of the trade. Okay, so buyer and seller dominance decides the number of quantity to trade. Okay, there should be a continuous negative, negative, negative or positive news should come. Then only VPI is going to spike. Otherwise, the VPI is not going to spike. Okay, this will save us from the trading zone. Okay, this is blessing for many. Like if you don't want to trade a volatility, this is a good blessing. They will see if the VPI is low, they are going to trade. Some people don't want the small micro drift. They want the volatility to happen. So if the people are looking for the volatility, then this is also one kind of indicator. So maximum time market is in a particular range. It works in a particular range. And here also we are working with a weak dominance or a clear dominance logic. I hope the indicator is clear to you. You can use this indicator with some kind of a trend following or a mean reversal algo. If you want to work like on a trend following, it should be increase the quantity with change in VPI. And when you want to work with mean reversal technique, it should reduce the quantity with change in VPI. So VPI you can use on a both side, either trend follower algo also, or you can use it with the mean reversal algo also. I hope it's clear to you. Try this test at your site and try to create the best use of VPI.